Hello, investors. Happy New Year. What a year calendar year 23 has been. Last time we ended calendar year 22, we had a lot of worries in terms of what will happen to global interest rates and inflation, how it is moving up, and its implications for growth asset classes like equities. It turned out completely different story eventually. Calendar year 23 turned out to be a year where actually equities in India, equities moved up 20%, and so was the case for a lot of developed markets. Actually, it was not a domestic phenomenon alone. In a lot of developed markets, including Japan, the markets moved up significantly on equities side. Domestically, the broader market did even better. They almost outpaced by 1 is to 2 to the large caps in terms of how mid caps and small caps deliver the return. Clearly, when you look back, one of the reasons that you can ascribe to it is while the interest rates increased, it did not have significant impact on the growth in the developed markets. The growth is slowing down gradually. The inflation has come down significantly. And as you progress through calendar year 23, it looked like from hard landing to you're going into a soft landing whereby your inflation is correcting, but the growth is not going into negative territory, except probably for Europe. And that's the reason probably the growth asset classes have held on far better than what we anticipated at the start of the year. Having said that, the fundamentals of uh, the basic economics or macroeconomics cannot be denied. So we have had a year where we had effectively 300-400 basis point of interest rate increases, which means the impact of it has to be felt somewhere, and it is actually gradually being felt in the developed market in terms of growth. So fast forward, when you look at today, how the scenario looks, it clearly looks like the impact of that interest rate increases and liquidity tightening is gradually becoming visible in growth. So nominal growth in basically developed countries will slow down significantly as you go into calendar year 24. Your inflation has been correcting. If you actually look at the 3-6 months rolling inflation, that to the PCE is slowing down faster than what the headline numbers are telling you, which only means at some point in time you're going to get interest rate cuts. But our hunch is that before you get those interest rate cuts, you are going to have basically some disappointments in terms of how growth looks, particularly in US. And that's the scenario in which we're operating. The global environment remains very, very complex. One, you had the inflation related worries which are receding and the interest rate cut expectations. But on the other hand, you also have basically geopolitics which is playing its part, and it has its own implications on supply chain, like what we are currently experiencing in the Middle East, whereby the rerouting of basically entire supply chain is intermittently happening, which is going to create basically additional supply chain challenges or inflation challenges at the margin. So that's the environment which we are operating in. The broader thesis in terms of how we look at the external environment has not changed. It remains complex, although gradually on one parameter it is turning significantly favorable, which is as the growth moderates in US, as the inflation moderates in US, the possibility of interest rate cut opens up, and that possibility of interest rate cuts, which are expected to be 2 to 3 in calendar year 24, also mean that the liquidity will flow out of US and towards the emerging markets, towards the commodities, depending on wherever the opportunities are in terms of equities, clearly wherever the earnings growth is in whichever emerging market. So that's one clearly incremental positive that has been happening, and actually manifestation of that you saw in last 2 months when we have received as a country a significant amount of basically positive FII flows, and we were not alone. Korea, Taiwan, Brazil, these were 3 other countries which received sizable flows. So that's the one key incremental change whereby the capital flows towards emerging markets wherever their earnings growth is will remain constructive. FII flows will remain constructive towards the emerging markets. That's one clear positive. Second is since the growth is slowing down, growth is moderating in US, Europe is in virtually recession, and China is not succeeding in actually showing any acceleration, which clearly means that your commodity prices at the margin will remain under control, which is visible in oil prices. And as it remains in control, it's at the margin positive for a country like India, which imports so much of energy. That's second. And third is it limits the pressure on currency and current account deficit for us as a country. So broadly, out of whatever complexities that you are observing globally, two things that are clearly positive is capital flows possibilities, the commodity prices remaining in check. Whereas one thing clearly negative is that external world is slowing down, and to that extent, its implications will be felt in the slowing growth, even the domestically sectors which are linked to the global supply chains. That's the global part of the discussion. Coming to the domestic economy, uh, I think so far so good. Most of the parameters remain in a very healthy shape. So you look at macro, you look at micro. Most of the parameters continue to look healthy. Of course, as we have been saying, domestic part of the economy looks like vertically split, whereby the anything and everything that is investment side part of the economy is doing well. Anything and everything that is to do with basically consumption or exports is actually moderating or remains weak. So, be it the utilities, be it the real estate, be it the capital goods, industrials, engineering, all those sectors which are basically the investment side infrastructure part of the economy, that continues to do well, whereas staples, FMCG, consumer discretionary, anything and everything that is to do with consumption, particularly low end consumption or mass consumption, remains weak. Luxury consumption continues to do well. So that's the story domestically. Of course, calendar year 23 was unique in a way, given that we have elections in calendar year 24. There was a huge thirst from government on public expenditures. So both government balance sheets and PSU balance sheets were aggressively deployed for project implementation, for incremental orders. So whether you take it power, utilities, defense, basically expenditure on railways, roads, has been very aggressive. That's one thing which will moderate going forward. That's our take at this point in time, post election, as the environment normalizes. So that has also been one of the key factor which drove huge amount of earnings growth in the core part of the economy. And the hope is, and the expectation is, that the public and government expenditure has started, and it will eventually translate into private capex. Probably the first glimpse of it is visible in real estate, whereby the real estate numbers across the board are generally good, although they are not as broad based as of now. They are limited to the pockets where the ticket size is anything and everything above a crore rupee probably, but at least it's visible in one large household side of the economy in terms of what is picking up. Even the private capex, OPEX is picking up, but it is still very nascent in terms of the stage where we look at it at aggregate basis. So that's the domestic piece. In terms of earnings, we will head into earnings season now, and as we have been saying, the test will be now probably third quarter and more so in fourth quarter, whereby margin tailwinds will start receding. First half of financial year 24 was a period where you had huge margin tailwinds. Anything and everything that is consumers of commodity actually saw margin expansion. As you go into second half, you have lack of it, which means margins will start coming in base, which also means the earnings expectations are lower at aggregate basis. Financial year 24, the total earnings expectation, just for simplicity, Nifty is 22-23% growth YOY. In first half, it was upwards of 30%, which means second half would be about 15% earnings growth from a earnings perspective. So that will be the key monitorable as you go into the third quarter and fourth quarter earnings season. As we see it, still the earnings remain healthy. In industrials, the earnings remain healthy. In real estate, the earnings remain healthy. In cement, the earnings remain healthy. In hotels, hospitals, the earnings remain healthy. In telecom, domestic pharma. Gradually, within the domestic cyclicals, financials are the one where probably earnings will start moderating, more driven by the NIM compression rather than the volume growth. So that's one space in domestic side where the earnings, not in all pockets, but for banks particularly, will have modest moderation led by NIM. So that's what is happening on earnings. Externally focused sectors, yes, earnings continue to remain challenged. As I said, out of the three parts of the, whether you look at it as an economy or whether you look at it as a market, The core investment cyclical part of the economy, earnings continue to be resilient, at the margin improving, except financials incrementally. For the consumption part, only the premium consumption is doing well, not so much about the mass consumption side. Barring probably two-wheelers lately are showing a little bit of sign of revival, and exports is third part, which continues to languish because it's more driven by what is happening globally, where the growth moderation is there. So IT will continue to see basically earnings downgrades. Chemicals continue to see earnings challenges. Engineering exports continues to see earnings challenges. So anything and everything to do with exports again is seeing challenges. So that's what is happening in whether it is domestic macro or micro in terms of earnings. But none of that is as of now is worrying, except probably the domestic consumption, mass consumption, which is very very slow. But rest of the parameters remain in a fairly good shape. Coming to how, given this context, how we are looking at market, clearly from a structural perspective, India seems to be, as we have been saying it again and again, India seems to be in a business cycle, India seems to be in an earnings growth cycle, it seems to be in a credit growth cycle, driven by the deleveraging that you have seen in the previous period, driven by the reforms that government has done over a period of time, driven by global supply chain rejig that is happening, driven by government's focus on indigenization of a lot of stuff that we were importing. So all those things are actually ensuring, along with the balance sheet, deleverage balance sheet, that you are on the right side of the business cycle, you are on the reflating side of the business cycle. So from a structural perspective, you got to be constructive. Valuations, when people realize that there is a cycle, always upfront themselves. So valuation, of course, there is a upfronting of valuations that has happened. And in this context, given the kind of returns that have been made over last 6-8 months, we think that as you go into second half, as you go into post-election, we see moderation or normalization of earnings growth in some of the pocket, which was led by margins also. And as that normalization of earnings happen, you should expect normalized probably low double-digit returns in calendar year 24, more probably front-ended than back-ended. That's the broader, very very simplistic take we are taking based on the past valuations and based on where the earnings are today, because you are expected to have about 15% earnings growth for financial year 24, 25, and then 26. So as you roll over, you will get the rollover returns. Multiples to a great degree in most part of the markets have expanded in fair zone. Probably large cap, flexi cap kind of categories today are looking, probably from a risk reward perspective, looking far better, because they don't actually have any inbuilt expectations in terms of earnings growth. As you go into mid cap and small cap, there is a lot of high earnings growth expectation that is built in. So in case if there were to be any earnings disappointment, that part of the market is more vulnerable, and that's why gradually we are tilting towards basically preference towards large cap, flexi cap, diversified funds vis-a-vis the small cap, mid cap funds as a category. That's broadly from our side. So structurally remain constructive, but from calendar year 24 perspective, you have to be little reduce your expectations in terms of what returns and where the returns are likely to come from in terms of categories. This is for last month and entire last year, and at the same time how we are thinking about these things. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.